All right, everybody. Let's get this ball rolling. Still got to connect the Discord. All right, everybody. Let's get this ball rolling. Still got to connect the Discord. Hey, y'all. Still got to connect the Discord. Y'all having a good week? Mm. Nope, not even a little bit, huh? Oh yeah, my bad. Well, brighter days, right? Oh yeah, all the time, every day. Yeah, I mean, let's kind of work this out because this is perfect. It ties into another thing I was going to cover today on the live stream. Um, yeah, we were going to do. No, I appreciate the symbol to work on. So we got Oxy here. It's around $41. And if I was looking to take a trade in this, there's a couple of things that I want to know. Can I trade the options on it? Because just because it has options don't mean I actually want to trade those options. If we find out it doesn't have good options, maybe we would look at its peers or maybe an ETF that has a lot of this particular company in it and then trade that because it might be better. So we got Oxy, we got a price range. It's less than $100 stock. So we got some expectations of what those options are going to look like to begin with. We don't want to see $2.50 and $5 wide strikes. And when we go in and we look, it's 50 cents wide. That's excellent, and we don't want to see really big bid ask spread. Now I'm seeing 10 cents or so, a little more, a little less. That's not too bad. It's manageable. But if we saw 75 cents or a dollar wide bid ask spread, that would be really bad. It has weeklies. That's another sign of liquidity. That's really good to see. If we didn't see weeklies, just walk away right there. You don't want to trade something if it's not liquid. It has 55,000 contracts traded today. That's okay for its size. You know, it's no Tesla, and we know that, but it has to have some liquidity, and it does. It's being traded. It's liquid enough. Next thing we want to see is, does it have a lot of strikes? If this was something that was really trashy, you might find two or three out of the money strikes, a bunch of strikes that are in the money, and then no volume on there at all. That would be a big warning or a heads up that you don't want to mess with it. So now we've established, it's got some liquidity, it's got weeklies, it's got the appropriate strikes, it's tradable. Now, how do I trade it? Well, always add time. If you think the trade might be good for 2 months, get 3 months. If you think it might be good for three, get six. Adding more time later can be a detriment. And even a trade that you get that is 9 months out or a year out, you could close it in 3 days with profit. It's not going to hold you back that much if you get the move you're looking for in the first place. So always add more time. The shorter duration the trade, the more violent the P&L is. So these options contracts move penny to penny, and they will move more in the shorter duration. So if you're looking for just a short move, use a short period of time, less than 10 days, something like that. That'll get you better movement. The farther out in time you go, the less those options move. It doesn't mean they won't move at all, especially if this stock went from 40 to 60 or from 40 to 20. Those options are going to move, even the ones that are out of the money. But short term moves or small moves, use short term dates so that those options actually respond to price moves. Contrary to popular opinion, options prices don't move just because the stock moved. If you're really far out of the money, and you see a good, decent sized move like $5 on a $40 stock, that's a good move. These options might not make very much at all, especially if they're all of these bag holders. We know they're bag holders because all the numbers are exactly the same. These are just trash. We don't want to mess with those at all. So, trading out of the money options, while it's really cheap, are typically a bad idea unless you know something the rest of us don't, or if you're just playing a lotto trade. Like, you buy a gas station lottery ticket, you have a snowball's chance in hell of actually making any money, but you know that when you buy it and you waste $2 and you say, so what? I'm going to give it a try. If you know that and that's your expectations, well, good. You didn't hurt anything. But if it's out of the money and it's going to cost you $200 and it still has no chance in hell of making money, you might want to reconsider that because, I mean, $200 is $200. So if it's out of the money, it will move less with price and more from the Greeks. If it's deep in the money, it will move more with price. These are what we call synthetic stock. So if you want to buy a deep in the money call, that's like buying 100 shares, only you just did it with an option. Synthetic stock, as long as it stays deep in the money, will move when price moves. So if this ticks up a penny, so will the option, back and forth. Maybe not penny for penny, but if it moves, the options move. That gives you a good idea of being in the money, out of the money. Now, on the sell side of things, if you're looking at this and you're thinking, I might want to go long at some point, I kind of like this. Well, you can pick where you would like to buy your stock. You could do a covered call. Absolutely. You could just buy the stock now and sell a call on it right away. Why not? But you could shop around and say, well, maybe I want to buy my stock at $40. Well, we're not at 40. Perfect. I can sell puts at 40. And as long as we stay above 40, I'm just going to make money from the puts that I sold. If we drop below 40, I get assigned. Now I bought my stock at $40 a share, but I've been collecting premium on it, maybe a week, a month, 6 months, however long I've been selling options at 40. Finally, I get assigned at 40 and I get to subtract all that premium from that price that I paid. And I really got it cheaper than 40. If I collected, say, $15 in premium before I finally got assigned, then my average share price is $25 a share, not $40 a share, because I can take $15 off of that price. So it's a good way to have a very specific level where you would like to buy the stock price and just be patient until we get that. Others have another approach rather than waiting. They just maybe already own the stock or want to get the stock now. If you was to get the stock now, maybe don't sell a covered call on it right away. Covered calls are going to cap your upside and they are your exit strategy. Selling a call is where you expect to get out. It will run you over and then you get exercised and you sell your stock at the price that you sold the call for. So if I bought the stock today and I sell a 46 call, when price runs through 46, maybe it closes at 48 and 50, I'm still going to lose my stock at 46 a share because that's where I sold the calls at, 46. If we don't run higher and instead we languish or go sideways, then I can just keep selling those covered calls and making money on the side while I'm waiting for my stock to perform, meaning it's just underperforming. And I'm trying to boost its underperformance by making a little money on the short calls. But if you're worried about it going down, short calls aren't the solution because it won't make you money. It won't protect you from a downfall. You sell a call for 60 cents on a $41 stock and it falls to $25, you're losing a lot of money on the stock, and that 60 cents you got in the option isn't going to even break a dent in the losses that you're getting. So if you're looking at a covered call strategy on a stock that you think might go lower, you have to think about, well, how am I going to defend this trade if it actually does go lower? Because those covered calls aren't defense. With that in mind, if you think it's going to go higher, consider the call that you are going to sell, because once it gets run over, that's your exit point. You don't want to have to defend the call by rolling it now that it's in the money and it's going to cost you money to roll it. You don't want to have to spend money taking profit away from you to get the call rolled higher and farther away from you just to continue on in the trade. If you think the stock is going to make big moves to the upside, just buy the stock. Don't worry about selling an option at all until it's warranted or needed. So if you get in thinking it's going to go to 48 and it just keeps bebopping around down here between 42 and 40, you could just start selling covered calls because, well, it just continues to hang out down here. But if you're getting in thinking it's going to go to 48, just buy the stock and let it go to 48. Don't bother selling options at all. Perfect. Perfect. Yeah, just buy the stock and consider only selling calls if the stock underperforms and you just think you could get more out of it. If you just immediately sell calls as soon as you buy the stock, then you could get run over on this next earnings, for an example. It could run right up and run you over. And I say that, but I mean, you could go way out of the money. The problem is there's no money way out of the money, right? I mean, let's go farther out in time. Let's look at, say, next year in September. Right? That's a good year off ish, kind of. And you could look at something like $70. You could collect, 45, 50 cents, but that's not very much money for the risk of losing your stock at $70 if you're looking for a long term buy and hold. In a year, this could go from 40 to 120 for all we know, and you're now capped out at $70. So I would wait to sell calls until you have a call selling signal, like we hit resistance and began to fall, and yet you're committed, you love the stock and you don't want to get out. You could sell calls at that point because we're working our way down, and over the next 2 or 3 weeks, or maybe a month or two, you could enjoy that short call making you money in the fade. But don't do it when we're near the lows, near support, an area where we could go higher, because you're likely to just get run right over. Cool, cool. I know a lot of people think that we can just run this continuous nonstop options wheel, and kinda we can if it's a big name like Netflix that's over $1,000. But when it's a $40 stock, we have to be more nimble about getting in and getting out and being strategic on when we sell those options and where we sell them at. I like to time it a little bit and get at the money or near the money. And I don't like using those far out of the money options. They pay a little bit, but you're just holding all of this risk in that little bit of money that it might give you. And if you trade it at the money or near the money and you're wrong, then you can easily exercise your way back out, or you've got a manageable role and you can position yourself into a better spot. How you doing? Yeah, we got BP. Um, I believe so. Let's bring it up. Oh, it triggered an alert. Yeah, it's got options. We've got weeklies on here. Um, that's a good start. It's got a reasonably decent bid ask spread here, two 50-cent wide strikes with weeklies. All of that is a really good start. Then, if we say, look at some of the stock on this, yeah, it's not bad. It's up near the highs. Uh, dun, dun, dun. It's beeping at me. Yeah, we were talking about long-term buy and hold and possible short calls or short puts. So yeah, the same thing would apply with this. I would look at this as a potential opportunity to own the stock either through selling puts first and being picky about where you get your stock from, or just straight up buying the stock now and only worrying about selling calls if it languishes and you think you can squeeze more profit from some short call plays. Yes, it is. I wish I had some clarity on that too, but I've found that Canada, Europe, come on over. We'd love to have you. I know it seems like we're getting a bad rep as being the country that doesn't want people from other places, but we want you guys. Come on in. The more the merrier. All right. So both of those kind of fell in the same wheelhouse, but we have another one on request that was let me get the name so I make sure I get Ion Q. And this is another one of those that's been in the media a lot. It has had some violent moves recently. And the request was to analyze this stock and then discuss how we could find a floor or a potential reversal area, something like that. So I've got my dashboard. I don't generally show this very often, but it is not because it's some secret or anything. It's just it's a think or swim thing. So I got a lot of charts, and we'll just start at the beginning, which is right about here. So this is a monthly perspective. Got to put it on the right chart. Generally speaking, I like to start on a monthly, especially if it's violent, if it gaps a lot, if it's confusing looking at the smaller time frames. Higher time frames gets rid of a lot of confusion, a lot of doubt. So we start on that. Look at the monthly. Ion Q on the monthly, it doesn't really look that bad. We've got a little bit of information from this previous high, these wicks where we popped up and got smacked back down, but we're above all that. And as long as we continue to hold above something like a key level, you can always find a key level, even if it's a $2 stock. There's got to be a round level in there, even if it's just $1. Look for big round numbers. In this case, $50 is our big round point. It's kind of in the middle of that wiki zone, and that would be a line in the sand. I wouldn't want to see this get under. But there's also moving averages. The 3 period monthly is what we've bounced off. And we didn't actually even get there, but we're close to it. If that breaks, it opens the door. And then, of course, we just use our regular drawing tools at this point. Where's last month's mid? And this is a log chart. So this drawing is going to look a little weird because of that. But the mid will be the mid. So $58, we're underneath that mid. And now we're at risk. We're at risk of breaking the three. And the next spot is 42. So it at least gives us a starting point. But now we can jump over to something like a weekly. We see that breakout better. We had a nice little cup and handle. Cup and handles only owe us the 50% and 100% of that move. So if we measure the cup from the top to the bottom, plot out 50% and 100%, we can see, did it reach its goals? And it did. It got to 50, a little bit of shenanigans afterwards, but 50 held. That was the stopping point. Everything that tried to get above 50 has rejected. Now we're coming back inside again. So at least we know from this analysis that it's behaving appropriately. It's not acting weird or doing things that are odd. When you spot a stock that's acting weird or doing something odd, you want to approach with caution, because technical analysis is designed to look at the past and examine that for clues to the future. We want to look at normal price behavior so that we can anticipate normal price behavior. Again, if it starts acting goofy, we don't have anything to compare that against other than just to leave it the hell alone. And that's tricky, because what does goofy look like? And sometimes we can't really articulate that, but danger comes from trying to get something from somebody or something that just doesn't have it. If there's no clarity because it's acting goofy or stupid or just gappy as hell and big wicks, leave it alone. But this is doing good. It rejected where it should, it turned where it should, it's falling back like it should. Everything is lining up. So we can go into a little deeper analysis, bring in some moving averages. We've broke the 50. We're headed towards the 200. And if that 50 that we broke, which is the 50 period moving average, once that breaks, we're headed to the next level. So now we've got $50, which is that key level that I marked. If we get under that, which is also the 100-day, and we continue to fade, then we're going to go to the 200, and it just continues to go lower and lower. But let's back up a moment and look at the weekly. Come on, Thinkorswim, keep up. My weekly don't have my moving averages showing. All right, we'll just add those. You want to look at the 10 week, because it's going to be a good line in the sand, very much like the 50-day. The 10 week, they're kind of close together. They're often close enough that as a trader, you can look at the 50-day and you can imagine where that 10 week is. It'll be comparable. They won't be spot on perfect, but it'll be close enough. But the 10-day is a really good signal of mean, and it becomes a price point. Now that we're underneath that 10 week, it's game on, and this is now uh, a dangerous long to take. You still had opportunities to go long when we were above that 10, but now that we're below it, taking a risk in this is taking elevated risk, because we always have to take risk. That's okay. That's normal. But this is more risk than I would be willing to take, because it's broken. The trend is broke and it's under the 10, and that gives us a line in the sand. If we're looking for it to improve, maybe to even recover, it would have to get back above that 10 so that we could look for long opportunities again in a healthier market environment. So that leaves us looking for shorts. Go ahead. We've got a deeper neckline than I would have expected, but there's the left shoulder, the head. We're looking for the right shoulder, and then perhaps even a deeper move down into the 30s. I would not try to short it from the hole. It's just my nature. I don't want to get short here now, but getting a nice bounce up into 60, 65, that would be a real nice place to go short. Looking for the next bounce into resistance, which would be the bottom of this pivotal point here, right around 60. I'd like to get there, maybe overshoot it, short from the highs of the latest pullback, that'd be fantastic. What I don't like is all of this naked area here with nothing in it. We want some kind of higher low or yeah, lower high. That's what I meant to say. Some sort of lower high way up here, anywhere up there, just not here. But if I'm looking for a long, that would be the only long that I would spot is we could take a short-term long off of a bounce, either the 50 or the 100 period moving average, try to run it up into like 55 or 60 short term, short duration, and being very mindful that this has broken the trend and that, there's still a lot of risk ahead. But by itself, this is also a high flyer. So you would want to check media and see, what group does it belong to? Is it getting social pressures? Is it showing up like on the Reddit boards, all that kind of stuff? And check the options flows. Check how heavy it is on the short list. If they're, if this whole pop was a part of a short squeeze and then the shorts got out, then we don't have them participating anymore, or maybe they're piling in and the shorts are getting heavier, then we could perhaps trap those shorts and get a bounce. So I would want more information than the chart alone can provide for this being, something that I'd be interested in to play. This is a much shorter duration chart time frame. I use this if I'm looking for a short-term trade, like a mean reversion bounce that we were just talking about. I would be looking for this kind of day, an afternoon session, maybe where the red candle runs up and leaves a big wick behind, looking for a chance to get in today and see like a gap up rally tomorrow so that we could get a trade that maybe looks like this, where it just went up for a few days and we had a little chance to participate in that before it heads down the other way again. That I would be willing to hunt for. So, all the textbooks talk about volume so much, all about volume, and they make it sound like it's this really big, important thing. The problem with volume is how generic it is. VC funds, stock buyback, there's all these things that get piled into quote volume, and passive volume is not active volume. We want to see active volume. But to see that, we need to know what they're hitting. Are they hitting the bid? Are they hitting the ask? Are they hitting above the ask, below the bid? We need to see that sort of behavior. Volume alone just is so generic. We can't distinguish if it was passive or aggressive. And by flows, I mean something like Thinkorswim's social tool. If you go in and you look, Thinkorswim has a bunch of dedicated watch lists. So I can come in and look at active on social, hourly report, daily report, weekly report, social activity. Maybe it's on there, maybe not. You can run a scan to see, bring up the weekly report, see if it's on the list. That's a good place. I believe that there's companies now that will monitor Twitter to see if a particular stock is getting active on Twitter, if it's being bandied about in like FinTwit, those kind of places. But look somewhere and see if it's getting any sort of social attention. Reddit boards, if you're on Reddit, then absolutely, poke around on Reddit. I don't go to Reddit, so I don't know if you can search Reddit like that. I have no idea. Me, I hit Twitter and I check things like the weekly report, the daily report, the hourly report here on Thinkorswim, and that's usually good enough for me. When in doubt, I use Grok because Grok is connected to Twitter, and then I'll just ask it, "Hey, what is the situation with this stock on Twitter?" And it'll do the search and let me know if it's active now, how active it is, and it'll compare that activity to previous days and weeks to say it's elevated or it's down a lot. And that's all from Grok, by the way. Grok's awesome. Yeah, I did mention check Reddit, Reddit boards, check Reddit flows, because that's usually how we say it. but not literally, not me anyways, right? I don't literally go to Reddit, but those meme stocks, Reddit board plays are what they're called. That's what you'll hear Bloomberg call them, places like that. They turned it into its own language. So generally, if you're looking, go ahead. Sure, you can always run comparative scans and ADRs, and all of that is legit. It is. But Investors Business Daily, for an example, likes to only mess with quality products, right? They don't mess with trash. And they make that very clear that if it's trash, they don't expect it to behave correctly and they won't mess with it. So if you're only looking at good stuff, then you have good data. I ain't making that clarification because I know people trade all sorts of things, good, bad, and otherwise. And just generically, volume's trash. But if today's volume is 4 times greater than anything we've ever seen before, I mean, that's notable, right? It doesn't matter if it's buy side, if it's sell side, aggressive, not aggressive. It's 4 times greater than we've ever seen before. Hell yeah, that's notable. That should be taken into account 100%. The problem is so many textbooks made it sound like the volume is the key to everything, and that if you see a breakout and it doesn't have quote elevated volume, then it's a poor breakout and you shouldn't trust it. All these other comments about volume as if it's the solution, and it's not, because volume, quote volume, is just so generic and petty that it doesn't give us the information that we need. Here's a really good breakout, and it was on elevated volume. Great example of when it works. And here was another one. Great breakout, big volume. Awesome. But 6 out of 10 times, 7 out of 10 times, you can go back and find really great breakouts, and there wasn't any volume of note. Sure, there was a little volume, but not enough, right? But as I've mentioned before, when Investors Business Daily talks about volume, they make a really good statement. You don't want to just see some, oh, I had elevated volume. You want to see, oh, damn volume. That when you bring up the chart, you're like, oh, damn, that's a lot of volume. That's the kind of volume you want to see, right? That now it's relevant. Now it has value, but just elevated volume. I mean, we've got some elevated volume right there. That was elevated volume. That was worthless. That did not help at all, right? So, sure, if it's enough volume, it'll be helpful. But I would find something else to rely on other than just volume, something better like volume profiles, which we're going to get into today, or digging down into the options if the particular stock has options to see what the put call ratio is, or when it comes to volume, how does it compare against the uh, available float, and what's the short interest and how many days to cover, right? Take that volume information and go deeper with it so that you can actually get something out of it. But when you run across the one, why the hell is it breaking out? I would want to find some data or information or why. If you can't find it, it's fine, but at least try to find out why. Then I would look at its peer groups. Okay, this one stock is breaking out. What peer group does it belong to? For an example, if it's Visa, what's MasterCard doing? What's Capital Markets doing? What's, American Express doing? What are the other credit card companies doing? What about the banks? And then from there, what else is going on? What's the options volume doing? If the stock that we're looking at has options volume, that's the next stop is okay, what about that? Because that'll be another level, right? To be able to look deeper into it and try to understand the breakout on why it's happening so that we have a better understanding of where it might go, how long it might last, and if it's a broad sector or broad industry impact, or if it's just an individual name. Maybe somebody's got their hand caught in the cookie jar, or they got caught cheating, they're getting sued, they're buying another company, whatever it happens to be, we understand why. And it's not just a breakout. But when you run across a company like IonQ and it's behaving in a way that leaves you stumped and you're like, I don't know what to do with this thing. It was ripping parabolic to the upside and now it's falling like a rock to the downside. The first thing you want to do is find a chart that starts to make sense. So you want to go to that higher time frame first to try to find some level of normalcy and then work your way back to wherever the discrepancy is starting to come in, or the doubt or the confusion. And when we come out to the monthly, Ion Q doesn't look that bad at all from out here, right? Out here, it looks pretty good. It's still above that white line, that 3 period monthly moving average, and it's still above 50, which is the key level of interest at the moment. So if I'm a longer term trader, I've got some depth and some clarity from right here that really provides insight. Shorter term, there's some risk, there's some danger. It's made some really big moves, and it's likely going to need to digest these plus 50 levels for a while. This log chart is misleading. It doesn't look like very much up here, but that's a $25 gap on a $50 stock. So that's a really big gap up here, a really big channel or range. It's just, but the tools that we use work on all time frames. The drawings and how we apply those drawings and the measurements, they always work. If you find that your drawings aren't working, it's not because you're doing it wrong. It's because that stock is behaving in a weird way, and weird price action should be avoided if you're wanting to keep your risk down. My live stream just went blank there for a moment. It kind of freaked me out. We're all good. Yeah, heck yeah. Everything I trade, yeah, everything I trade, I want to understand why is it moving. Price just doesn't randomly move on its own. they're they're hitting it for some reason, and maybe we can't find the answer because that happens. It happens a lot more than I'd like to admit. Maybe we can't find the answer, but I'll damn sure look first. And if the answer is I couldn't find anything, well, okay, I couldn't find anything, but I'm at least going to try. We've got a lot of videos that we've already covered the volume profile. Today, we were just going to talk about very specific parts of the profile. But when it comes to a breakout by itself, all we're trying to understand is what is that price doing on that breakout. Breakouts can be from anything. We're not necessarily talking about breakouts into all-time highs. It could just be a breakout of yesterday's price, and we're trading that kind of a breakout. So the volume profile is going to help us better understand where the trading had already happened, right? Because volume's in the past. So if we just bring up a volume profile, we'll be able to see what it shows is previous day's price action or previous hour, previous bars, whatever we happen to measure with that volume profile. This is the ES with 1 week of profile. We can see a breakout of last week's range, and we can see on this week's profile where all of the trading volume is up there at the highs. We can look back at previous weeks and see that there was a point of control back here, a big cluster of volume that acted as a resistance, and we ran into it and we rejected it and fell back down. We wasn't able to get through that previous level of resistance. That was volume on a volume profile that was useful to us on this breakout. That's a really good example. So we would use that tool to see anything that it has to offer. Previous days volume, previous week's volume, just looking left and asking what happened back there, and is this breakout going to hit anything that I need to be concerned about? When it comes to the put call ratio, Thinkorswim has some really cool tools. And one thing that it has unique to Thinkorswim is Sizzle. Sizzle is something that they made up. That's why I know it's unique to them. They just made it up, which, I got to give them credit. They are why I just make stuff up all the time, like TRB lines and 111s. And I just make stuff up. But once I make it up, I keep it and I use it forever. So, you know, we can come up with things all on our own. What they have here is sizzle, and sizzle means 5-day average. It can be 5-day stock volume, 5-day volatility volume, or just volatility, put volume, call volume, or put call volume combined by looking at the sizzle index. Anything greater than 1.0 is greater than average volume, average 5-day volume. If we look at a call sizzle at 1.0, we know the volume today in calls is comparable to the 5-day average. But if it's 2.0, then we know it's 100% greater than the 5-day average. If I see a breakout in stock, I can come in and look at the stock sizzle, which is volume. Is the volume today greater than the 5-day volume average? If it's above 1.0, then I know it's above the 5-day average. If we add to that a bunch of puts being traded and calls being traded, then we can go in and examine what calls and what puts. Are they deep in the money, deep out of the money, far in time, closer in time? Were they running as a spread? Are they hitting at the ask or at the bid? And we can evaluate all of that within these options statistics and the time and sales, even bringing up options depth if we need to evaluate where a bunch of open interest might be located to better understand the aggressiveness of this trade, and if the breakout is something that's spreading through time or if they think it's just going to be short duration. Because if it's short duration, they won't trade next year's options, for an example, right? They'll be trading 0 days and this week's, next week's options. They'll keep it short in. So it just provides more clarity on the breakout. Yeah, they're the ones who's doing the bulk of all of the trading. I mean, don't get me wrong, it's been proven that retail can and will move a market. That's why Reddit is such a threat. But most of the time, the trades that are being taken, it's institutions, and their size and their bulk is what moves the market. Yeah, but I'd say it's deeper than what I was prepared to do today, and it'd take us way off topic. So I can put it on the list for Friday, but to go any deeper on it would be just like hijacking the rest of the afternoon on breakouts. So I can add it to the Friday stream. Volume profile, evaluating a stock that is misbehaving, and uh, there was one other one in here. Oh, gaps. Those were the topics on the list today. But we're going to put breakout evaluation on for Friday. And even if you can't catch the stream, it'll be recorded. You'll be able to catch the replay because I'll put it in the replay channel. Yeah, there's definitely more to it than that. So the other the last bit when it comes to ion Q or just any stock in general, if it's misbehaving, it's a red flag. You want to either approach with a small size and slowly build into it, or step back and find more information that doesn't come from the chart. Look at its peers, look at the industry, the sector, try to have a better understanding of why the stock is misbehaving, and see if you can find an ETF or an alternate product, even just derivatives if you have to, jump into options, anything rather than trading that unknown product. And that your analysis should fit. If it doesn't, it's not because you're doing it wrong. It's because that market is just straight up misbehaving. And it's greater risk to trade things that aren't acting the way that they're supposed to act. The next thing on the list is these volume profiles. Now we've got a lot of videos. We've been covering profiles a lot. So this isn't a video today on what's a profile 101 because we've got those. We're going to be covering a piece that we haven't really gotten into yet, which is the profiles shapes. In my live streams in the morning every day, we talk about profiles, and I mention how you might find a particular profile shape like a D or a P. My drawing tool quit drawing, quitter. Uh-huh. So if we get these different patterns, the D or the P, or what do they stand for? What do they imply? And how could we potentially use that? I do want to make it clear I don't trade with indicators. So while I would use something like a volume profile to perform analysis and look at previous days trading and levels that it may offer, I'm not going to trade those levels as if they are some tradable signal. So you got to just kind of keep that in mind. I don't trade that way. And if that's what you're looking for, you'll have to build those sort of triggers on your own. So when it comes to a profile, what are we trying to do with it? The discuss in more detail the volume profile and how it can be used to trade on different time frames. So you can go to a monthly, daily, weekly. I do it every day when we go out to this 65-minute one. We're looking at the entire week of volume and we package that together so that when I look left, I see all of last week. We also look at it on an intraday basis in the morning briefing in this format, where we look at one day and we look back at the previous day. And that's using multiple time frames to establish price levels. These price levels, or pivots as I like to call them, are opportunities that we can use for trading. At the bare minimum, we can use them for analysis, which is what I like to do. Where's a potential area of resistance? Where's a potential spot that we could get stuck in or stalled in, or areas where we could move really fast? If the volume profile has shallow spots, we can move through those areas a lot easier because there's no footprint there. There's no previous behavior that's going to slow us down. But if we run into a profile that has a lot of lumps, a lot of big high volume nodes on it, and shallow areas in between, then we can see that as multiple distribution zones and that we can go from one zone to another zone, moving through the shallow area quickly, but likely getting hung up in the higher volume zones or in the high node zones. There's no wrong answer or right answer on what time frame to use. I use 65 minutes when we're looking at this one that we look at every day. Why 65? I just like that 65. I don't know, 60 minutes would probably be just as good, maybe a 2 hour. But I look at the candles, and I don't use SPY in the mornings. We use the ES. But I look at the candle on the chart that I have, and I evaluate, do I like those candles? Are they too big? Are they too small? Do I feel like I'm missing sort of some information? And if I am, then I want to change the chart time frame to give me the kind of candle that I'm looking for. And unfortunately, I don't have a good answer for anybody who says, "Well, I don't know what time frame to use." I don't know what you want. You do. So try different time frames and see what talks to you, what you like. If it's way too cluttered and you find that you're not getting what you want, go to a different time frame and keep shopping around until you find something you like. You can start with what's popular. And what's popular is a 1 hour, and then using something like a 30-minute, um, and then just kind of work from that popular area and start making adjustments. The other piece to this is, well, how much data am I going to get in each profile? That's 1 week that I just circled. This is 1 week, and then another week, and another week. And I'm really comfortable doing 1 weeks at a time, and they're really popular. So I didn't make that up. That's been around for a long time. And then we have the 1 day ones, right? Day by day. But you can do intraday as well. You could just do Globex, and then you could just do RTH. You can combine the two. You can break this apart in so many ways. All we're trying to better understand is, hey, when these candles printed, when I look left, where was the volume? Where was the greatest amount of trades? And when we got to those highs, was it really thin or was it really heavy? Meaning, did the buyers just get exhausted and we fell back? Or did we actually run into a bunch of sellers up there and they hammered us back down? Because that is entirely different. Same thing down here. When we got to the lows, how did that reversal happen? Was there a bunch of buyers running it back up hard and aggressive? Or did we just see the sellers get exhausted and we just slowly started to creep back up? So the volume profile is there to give us more information. And that's the way I really like to use it. I'm not looking for this thing to give me a trade trigger or a signal to get in or to get out or anything like that on its own. It's just designed to highlight specific price areas on the chart where I can be better prepared and maybe manage my risk a little bit better. Yeah, price action generally, yeah, it's volume. Volume by price. How many contracts were traded at that particular price point? So instead of having a volume down at the bottom that just says in that minute in time, we had this much volume, this volume is saying at that particular price point, you had this much volume today. And that's why they call it volume by time. or volume by price, depending on if you're using a volume profile or a TPO profile. But it's just volume. The point of control is where the greatest amount of volume took place in the time frame that you're measuring. And price moves through the shallow areas relatively easy because it doesn't have all of that volume resistance to deal with. So not only was the shallow areas created because we moved through there fast and we didn't leave much of a footprint behind, later on, price can move back through that shallow area relatively easy because there wasn't much of a footprint left behind. It's kind of a double-edged sword, right? The profile was made by a lack of volume and a lack of resistance, and later price moved through that area again because there wasn't a lot of volume and there wasn't a lot of resistance. And generally speaking, we try to target the next high volume node as the next place we're likely to go. It's getting a little cluttered up there, isn't it? That's better. So that's the idea behind the volume profiles. Now these profiles have very specific patterns connected to them, and these patterns can give us clues to what to expect. And it doesn't mean that it's going to happen, right? Crystal balls don't exist, but just like when we talk about the narrow and wide channels on a floor pivot, how they give us clues on things to expect, price makes these volume profile patterns. And historically, those patterns have led to specific behavior. I zoomed back out because we have this spot right here, and I wanted to highlight that. It's a classic P shape pattern. It might be a little hard to discern up here, but there's the P, which is a distribution node, and it's got the point of control up there. And then we've got this long tail. That is your classic uppercase P pattern. P is in Paul. We've got a lowercase b, and then we've got a classic D. Now, I asked AI if there was any pattern that I haven't mentioned here, and it foolishly said there is a B pattern. But if you go through the textbooks, they make it very clear that while it looks like a B, we would not represent it as a B. We don't want to call it a B because it's not a B. It is two D's. It's D twice, D squared. I don't, we'll call it something else. It's just a D that had another distribution. It's a double distribution. So no B's. But it did have another one that I didn't consider as a letter. I knew the profile shape. I just didn't put a letter to it. It's the I pattern, which has no distribution to it at all. And it's just skinny all the way in either the up or the down direction. And there's just no distribution. And to be fair, I'll give AI credit for that one. I didn't think about that as a pattern. So uh, uppercase P, uppercase D, lowercase b, and then the I pattern, or maybe a lowercase l, I guess, you know, if you wanted to. Yeah. How's that one play out? You got to soak it in cider? So for the D pattern, that resembles a D with the highest volume point of control clustered near the center, creating a rounded bell curve appearance. The top of this P is a good example of that. But the next week's profile, that's your classic D shape right there. So this D is at the top of a long run. And so that's where our P shape comes in. It's just taking this D and adding a tail on the bottom of it. If we took this D and added a leg on the top of it, that would be our lowercase b. That indicates balance or consolidation. To me, it's always those two words: expansion, contraction, expansion, contraction, back and forth, right? That's the market. It's just expansion and contraction. So the D shape is a representation of contraction, consolidation, balance. Any one of those would fit. This is where everybody's agreeing on price, or if you like those words, fair value. You will never hear me saying that as a part of my own stream, but I'm just reading off what's there. It's often seen during sideways or choppy markets. If you're looking for breakout opportunities, you want to find price in a D shape pattern. At least I would. I wouldn't want to find it after it's already started a breakout and started a run, or worse, already made a big run. I want to find something before the run. So finding that on a daily or a weekly or a monthly, something is tightly knit and consolidated, that to me is a market that has the potential for a breakout opportunity. Volume profile on TradingView is fantastic, by the way. I mean, Thinkorswim is good. I'm very comfortable with Thinkorswim, but TradingView has all sorts of really awesome drawing tools and homemade indicators when it comes to volume profiles. So you don't have to buy one. I get it. You're willing to pay for it if you need to, but you don't need to, because TradingView's got free ones that get the job done really well. I've got some of my Thinkorswim charts built on TradingView, so I'm just kind of scrolling down looking for it right now. Um, oh gosh darn it. As soon as you go looking for it, you can't find it. But I think that's where I need to be. Let me just check. Nope. These are where I need to be. So here's my 5 day, 5 minute. I call it the 5 by 5 chart just because I like giving things funny names. Today's profile, the previous day's profile, and as I scroll back, I get more and more profiles. This is the setup that I use on Thinkorswim, so it's not really modded all that much. But on TradingView, you can tell it to carry forward that point of control. Like every day in my live stream, I draw this and I draw it out to where it extends. This one does that drawing for you if you want it to. It doesn't have to do it if you don't want it to. That's really cool. I wish Thinkorswim would do that, kind of. Um, you could probably code it to do that, but whatever. And here's this point of control from like way back here, how it's carried forward. That's a virgin point of control. It just does it for you automatically. And this is a free one, right? I didn't buy this. Look up SVP HD, right? It's probably something like super volume profile or something. I don't know what the S stands for, but search for that one and you'll get what we're looking at right here. But you can find others that you can change to show like delta profile instead of volume. You can do, oh man, just they got some really cool tools. They'll even do intraday developing points of control, like where something is getting a lot of volume real fast right now. They'll start highlighting a whole new point of control before it's actually a full point of control. So yeah, they've got some great stuff over there. No reason to buy one. And try searching for different names. TPO is a profile. And then, of course, you got volume profile. Try using acronyms and letters like VP. Um, and then you got the drawing tool as well. So you can come in and use the anchored volume profile. This thing is fantastic because you hand draw where you want to start and where you want to stop. That way, if you want to examine something, say the low of a range, for an example, or um, let's use it today. We had that big event bar earlier today, this one bar right there. I'm going to hide that. Say I want to trade now earlier today after we had this big event bar. Event bars are really important to me. So I look at this, I'm like, "God, I need more information. I want to know what happened inside of that one single bar and what's happened since then." Well, this is since then. It's not exactly what I was going to do, but that works. Now we've got just that area under the point of control, and I didn't have to do a bunch of math and figure out where it was going to start, because you can kind of do that on Thinkorswim, but it's a pain in the butt. The anchor is supposed to start and stop where you tell it to stop. Maybe I used the wrong one. I should have used fixed range so that you can start here, stop there, and now you have just that much of the profile. Really helpful to analyze just a small key area in the market to better understand what happened at a low or a high, at a market open, an event bar, anything like that. It'd be really valuable. Thinkorswim doesn't have that, and I think that's a handicap. You know, but there you go. So the drawing tools, never overlook those drawing tools. They're just so valuable. All right. So when we are in a distribution area, this consolidation zone, contraction area, you can play the edges, but the profile is going to be a bell shape, right? So it's not going to really offer you shallow zones and um, high volume nodes and multiple distributions, because it's a D shape. What you want to do with those is either play from edge to edge, from high to low and low to high and high to low, or look for breakouts that fail, come back in again. If you don't want to do any of those, which can often be um, classified as scalps or short term trades, you could look for the range to finally end. That if we are in a consolidation period, then, well, we can't stay there forever and we will come out of it. And you could just, set that up as your trade plan. Okay, we're in this range. I'm going to set my alerts on the edges and I'm looking for, a significant breakout or breakdown. And that's going to be my trigger to start getting some trades on. The P shape pattern, we had one of those not too long ago, right? It's back here. I think Thinkorswim did a better job of showing it. Whoa, WTI, U.S. lifts, key restrictions on Ukraine's use of Western long range missiles. Hoorah. So there's our P shape profile, even though this really it doesn't do it justice compared to what we were looking at on Thinkorswim. It'll work. Has the thin lower section and a wider volume cluster up at the top. The thin lower section suggests a rapid move or rejection of lower prices and then a consolidation. Now that's how it reads, but if you look at what happened last week, that's not what happened. We spent all week, well, all day up here, and then we fell down. So it's not like we went down and rejected and ran back up and then we built this big profile, because that would be completely different. Let's try this on a higher time frame and see if we get a better, maybe it was a 1 hour. Yeah, we'll let that 1 hour develop. I think that was a better one. Or set it for the week. Yeah, there it is. See how we had that whole week. And still the dump came at the end of the week. So the textbooks really um, don't see two sides of this coin. In the textbook, it's just, well, we had this quick rejection and then price consolidated up at the top. But that's not how our week was built. We consolidated all week and then we had a rapid descent. Still, you can look for entries on a pullback retest to the upper volume cluster or a continuation higher. Because after that P shape, you could, if it had rejected and ran back up again, look for a continuation higher from there. The lowercase b, it's just the P upside down. So wide at the bottom, skinny area across the highs. And again, the textbooks really do a disservice thinking that it only has to happen one way, where we were ran up, rejected, ran back down, and then sat there at the bottom consolidating. When we know that that's not the only way it can be built. If you do have a B shape profile, look for short entries on a rally retest of the lower volume cluster, or the upper area represents a zone of low acceptance. Now, when I see those zones, those lower zones, it's like we've talked about before. I want to better understand what happened with price when it moved into those levels. So I'm looking, if it was a drop like this P, that's a weekly profile. I'd want to go and use the multiple time frames here. I'd want to go to that day where the big move happened and put a profile on that one particular day. Well, we know it was a Friday. It was the 10th. So we could just jump back, go to Friday the 10th, and then examine it better. See what kind of market activity we had that day. Maybe even look at the news of that day to try to better understand what happened with price action. After we're done doing that work, we can still just lay those levels out, carry forward that point of control, the value area low, the value area high, and run it from there. In previous weeks, people have shared work for like Jim Dalton and other footprint traders. You're really going to want to read those books because they go into a lot of detail about these patterns that we're talking about today, and they have a lot more specific examples rather than these generic ones that I've been using, including the outcomes, because you will better appreciate a tradable strategy when you can examine multiple outcomes where they say a P is supposed to do this, and that's actually what you get when you get to see 5 or 6 different examples of it and can say, yeah, that works great. I got a lot of examples of that working really well. If we don't have the examples, we don't get to build the trust, right? We don't get to put our hands on it and turn it around like a Rubik's Cube, grow some confidence in our ability to spot it, recognize it, analyze it, and use it going forward. On that big P or B, the distribution area, that point of control becomes a valuable spot. If and when we get back to that level, you're going to want to anticipate trader's remorse. That can be expressed as traders who wanted in but didn't get a chance, traders who got in and are now upset that we're back where they started. It can be both of those things, but the main thing is anticipate elevated volume at that level because there was elevated volume at that level last time we were there. If it happened a year ago or 2 years ago, then, put it into perspective. It probably doesn't have the same level of influence. And probably shouldn't be shopping back 2 years on a volume profile and pointing out a point of control and then expecting something from it. So, how fresh is it, I guess, really matters. The B pattern, which is not to be referred to as a B, is a double distribution. It's where we had a distribution level, we left that one, and we built another one. The reason we call it a double distribution and not a B is because those distributions can actually be separated by a shallow area. And a typical B If you're going to work, work. And if you're not, then don't. A typical B would look like that. A double distribution can be a B and then a pull and then another D. And so it could be like that. And that doesn't look anything like a B. So we don't want to call them Bs. We just want to call them either a double D or a double distribution. Some call it something else. Just don't call it late to dinner. And in those shallow areas is where we could anticipate moving quickly. Each distribution can have its own point of control, but you might find it difficult to mark that other point of control. You might have to do it by hand. I don't know of an indicator off the top of my head that will mark both points of control for you. It'll mark one or the other, but both high volume nodes would become relevant at that point. And if you get something really nasty that has these distributions in multiple points, then every one of those high volume nodes become areas of interest that you need to be concerned about. You can carry those forward as the zone itself, or you can mark out just the highest point in each cluster and carry it forward as like a unique point of control, to where if we get back to that level, you can anticipate higher volume, greater trading activity, potential reversal spots, things like that. In the textbooks, they talk about it as two distinct areas of fair value. Again, words you won't hear in my streams. Often appears as trend continues, but pauses at intermediate levels. That I've never quite appreciated it. I don't like how they lay that out, but that's from the book. So, you know, maybe I just disagree with the book, but there you go. Both areas are key. The shallow area is as important as the high volume areas or the large areas because each one has something to offer. In the shallow areas, they're important because, well, we're probably going to move through those without a lot of trouble. And you're going to want to know where those are at because that's where you'd look for expansion plays. And then the big areas are important because that's likely where we're going to get hung up and have a harder time continuing to move in that direction. And so that'll be important to you too because it's likely where we're going to pause or consolidate or reject and reverse, and go back the other direction. So I did mention the I pattern or the L, either one. I did not consider that as a letter of the alphabet to be considered. Honestly, it never crossed my mind, but it is a pattern. And I think mainly it didn't cross my mind because it's been a long time since we've ever had a day that didn't have some sort of distribution in it, either at the top, at the bottom, in the middle, somewhere. I can't remember the last time we just had a day that fell and fell or ran and never paused along the way. But I'm sure it exists. So it has to be considered, right? A very long, narrow profile with a low volume overall. It typically occurs during strong directional trends where price moves quickly with little time spent at each level. And the reason I really grabbed that is at first I thought, who cares? I can't remember the last time we saw one of those. But we were just talking about anchoring our profile. And if you was to anchor your profile, for an example, on this drop, or maybe just that drop because of this little consolidation, that would cause us to bulge. But if you was to measure just one key area, that's the kind of profile that you might actually get that, right? And then you'd be like, oh, hey, we covered that in the stream. I remember that. So I didn't want to skip it because profiles can be whatever size we want, 1 hour, 1 day, 1 week, 1 month, and you very likely could come across it. It is a signal of an imbalanced market, which that is just straight up trading 101. We're moving because people are not happy with the price we're at and they think they can do better somewhere else. So to kind of back up to all of this, the question was, well, how can we use this in trading? Now, I've already mentioned I don't trade with indicators like profiles and things like that, but they form the foundation of my trade. Meaning, if I mark out a high volume node and it's an untouched point of control, then I'm going to be paying attention to that particular level when we get closer and closer and closer to that level. I won't want to trade if we're right underneath it and we're trying to break out, like here for an example, where we broke out of this high and we were going to go higher. There wasn't a lot to offer there, right? We're going from 87 to 91, and then we were likely going to hit our head. And we know that that's a high profile, high volume node, and it's not just one tiny little tick. It's actually a zone or an area or a range. And that we have to be concerned about a lot of resistance at that level because that's where the point of control is that I carried forward from that big bar. That would inform my trade, and I would not want to trade this breakout higher, knowing that we're going to hit our head there and are likely going to reject. And then when it did reject, well, that adds confirmation to what I had already assumed, that this was a hard level to get through and that we weren't getting through it. So I could snap some fib lines, look for a 111 or a 1236 rejection, try to find a short opportunity to participate in this move because it played into what the analysis had already said, that 6790 or 6791 is a high volume area, a previous point of control, and a difficult level to get through that we very likely wasn't going to get through that day. And we didn't. Using it for that becomes really valuable, that we can look at previous days and spot these high volume areas and say, well, if we break out, we're probably going to go to that high volume area. Or if we break down, we're probably going to go to that high volume area. What happens when we get there? Well, you got to anticipate, how did we get there? A single candle, one big ripper? Did we slowly grind our way into that level? Because if it's a big ripper, we're probably going to reject it. If we grind our way into it, we're much more likely to grind our way through it because we're building structure as we work into that level. But that doesn't involve the volume profile at that point. That involves just reading the price as we move into those levels. They absolutely can be resistance. Yep, that's exactly what I was talking about. This level back here, it is a magnet that we're likely to go back to, but it is also very likely going to act as resistance when we get there. It's where the greatest amount of trading took place, and I call it trader's remorse, but there's a lot of fancy words for it. And what I tell people is, just imagine that was you and you went long or you went short, and now we're back 2 days later, 5 days later, and now you're looking at your trade like, yeah, I got in here, and now 5 days later, we're right back where I started. What are you going to do? You're probably going to do something. Close your trade, maybe double down and add to your trade, but you're going to react. And their reaction is what we're anticipating. Maybe they add more, maybe they close. But even if they close the trade, it's still a trade that took place. And those trades are likely to stop price, slow it down, hold it back. So it becomes magnets and forms barriers that can stop price from moving in that direction. If the zones are wide, we can get trapped in them. So we built a wide zone on Monday. On Tuesday, we stayed trapped inside of it. We were trapped inside of it half the day today. And then finally, we broke out of it. If we make it through the halfway point on our way back up, that's going to become the target. That's where we're going to look to go because we've built out days at that level now. So I'll be carrying forward that zone for quite a while now until I'm confident that we've resolved all of those traders up there. At the end of the day, these volume profiles add pivot points. I don't like to call it pivots because it confuses people, but a pivot is any line. I can just randomly draw a line and I can call it a pivot. It's supposed to be where price turned and went the other direction. That's what it's supposed to be. If you think about basketball players, when they pivot on their foot and they go in another direction, they pivoted it. Well, when price pivots, we can mark that spot. But honestly, any line that we draw can be called a pivot, right? So I don't like to use that term too much because it just adds a lot of confusion, especially when there's indicators called pivots. And then, we start getting that confusion. But these profiles add levels, they add lines that we can carry forward into today's trading, and they can span days, weeks, hours, months, as far back as we want to go, just as any other line can. We can mark last year's high, last year's low, last year's close. Those levels have value. We can do last month, last week, yesterday, last hour, right? We can do lines as far back in time as we want to go. But the fresher the line, usually the more responsive it's going to be when price gets there. And these lines by themselves don't add a tradable signal. They just highlight a price point on the chart that says, hey, when we get here, it's very likely we're going to see price respond there. Maybe that will be resistance. Maybe it will be support. Maybe it'll be a magnet. We're not always sure just because the line is there. We have to do deeper analysis and figure out why that line is there. Where did it come from? And then have a plan based on it. So in the mornings, when I do my morning briefing, we look at Globex high and low. And if you start building these out, let's just go to a blank spot here. No, not that one. Leave that one alone. Yeah, that'll work. Take any normal random day and start off with something like ADR lines. Well, that's a good start. Let's add some overnight. It's not much, but just that little differential to tell the difference in the days. So you got the ADRs, and then you've got yesterday's high and yesterday's low. That adds more levels. And I'm going somewhere with this, so it's not just me losing my mind. Yesterday's high, yesterday's low. Then we've got the week's high and the week's low, if it's relevant, and last week's high and low, which are always relevant. Hey, appreciate you showing up. The rest of it'll be in the replays. You'll be able to catch it there. Got to get some sleep, buddy. It's late. You're going to be tired tomorrow. Then from that, you've also got the point of controls from the volume profiles. On top of that, you've got the I don't like that one. I should have picked a different one. You've got floor pivots. The point is, by the time you're done adding floor pivots and profile lines and the previous profile lines and the previous highs and lows, you got so many lines on the chart, you don't have much room for price to do anything without bumping into something. And what we end up with is the threat of analysis paralysis, that point of view where you're so compressed and you got so much stuff on there that eh, no matter what we do, we're going to hit something. You don't know what to do next. And that's a bad situation, right? Plus, it's really confusing. You get so much stuff on there, you don't even know what becomes relevant anymore and what is priority and what should be secondary and what's more important. And it just becomes this big, yeah, yes, perfect. I'm gonna use that. It just becomes this absolute mess, right? And that's what we want to avoid is we don't want so much stuff that we can't even get anything done anymore, right? Like look how cluttered that is. Now, don't get me wrong. If you're looking at this every day, this might be normal to you, right? But if it's something that you've never seen before and you look at this, oh my goodness, where's price at and all of that? And can I add anything at this point? So you want these levels to add something. And if you haven't heard me say it in my live streams in the morning, I have particular levels that I will look at and I will evaluate them, but I won't carry them forward into today's trading, right? I don't because it doesn't have anything to offer me price wise as a pattern, as a signal, as a useful tell that I'm just not going to carry it forward. But I do have my notes, right? So in my notes, I will highlight, hey, this area is a key area, between say 6780 and 6760, and that if we begin moving towards that, it's going to be a magnet. If we get there, we could get stuck there. You know, I will add that to my notes, but I won't necessarily bring that line in because it's just one more line and it's just more clutter. Same with this grid. The textbooks tell you to carry these lines forward, all three of them every day: the value area low, the value area high, and the point of control. I don't do that. I've got so many lines already. And what you'll find a lot of times is that the value area high was actually yesterday's high. Well, great. I'm already marking yesterday's high. I don't need a reminder. Or, the value area low may be yesterday's low, or it'll land on the 50% mark or something like that. Great. I don't need to mark it twice. So if you have enough lines and levels and you don't feel that you're going to get anything out of these lines and levels, don't carry them forward today, right? I'm not a big fan of mechanically doing something just because that's what I was supposed to do. I want to do it if I see real value in it and it's going to give me something, give me better understanding, give me an opportunity to set alerts, something. So, what do we do with those levels? Well, that's where your trading plan comes in. And it wouldn't matter if it's a volume profile or a pivot point or just a line based on yesterday's high. You still need a trading plan for what am I going to do when price gets to XYZ, whatever it happens to be. It is good to see that we got our breakdown and our expansion, just like we talked about in the morning briefing, that this narrow channel implied if we got a breakout, that the breakout would stick and that we could continue to run through the day. This was the breakout point that we needed to get. We got it. And even though we tried to get back inside the box, we failed. And we ran all day, all the way down to the weekly channel top. That's pretty cool. So, those volume profiles, use them to help you better understand what happened in the past and to highlight key levels going forward. But for me, they're not trades. You'll have to come up with something else for that. Maybe Kevin's video talks about them in trades. I don't know. I know he's talked about profiles. So maybe his videos do that. I just don't know. Yeah, that's awesome. I love hearing about saving money, saving positions as much as I like hearing about making money. So that's really cool. I'm glad to hear that. I don't get enough feedback, on whether it's good or not. Heck, a lot of times people don't even mention them, and it's kind of like I'm just screaming into the void, and maybe nobody's nobody's paying attention to them at all. So thank you for that. Thank you for that. Can't find ADR. Yeah, the thing about ADR, I'll share mine with you, is when I was running research on rate of change, right? And the rate of change is one of the oldest indicators that's ever existed, even older than moving averages. And when I was working on rate of change, I came across this concept about average price moves. And it's kind of a big deal. It's what options are based off of, and how volatility can be measured to define how far we should go. And I thought, well, this is just a fantastic concept of price has an average move. And a good analogy is what's your gas mileage in your car? Do you average about 350 miles a tank, 400 miles a tank? And when you get near that, you know you're pushing it. But you also secretly know you can go farther than that. You've done it before, but you know your average, and that's usually where you get more gas and it's usually where you stop. That's average price action. And I thought, well, that's fantastic because how do we know a stock is misbehaving and is moving farther than it normally would move? If it's a crazy high flyer like Tesla, it could move 7% and that could just be a normal day. But if SPY moved 7%, we'd all be freaking out, right? Like that's a that is a big move in SPY. So I wanted to better understand how I could look at a stock and instinctively, intuitively understand what its average price was doing. The problem is if you go looking for an indicator that'll do that for you, what everybody tells you to use is the ATR, average true range. And it sounds really good. Average true range. What's not to love? The problem is the math is complicated. If you was to go to stockcharts.com, they wrote a really good article explaining how this math is derived. Still screwy as hell. And it does weird things to get the answer that I don't really appreciate. And I think they just way overcomplicated it. Some Canadian engineer got a hold of this thing somewhere along the way and just blew it all out of proportions. I just wanted something to very simply answer my question in a way that I understand. So I said, forget the ATR, give me something else. Let's just use some average math. The same math that you use when you go bowling, right? You just add all the numbers together and divide by however many numbers you started with. So I built the ADR instead, average daily range. The whole idea is I want to answer the age old question, what have we done in the last month? Have we, on average, moved about 1% a day? Because if that's what we have been doing in the last month, what do you think we're going to do today? Probably move about 1%. Well, if we did move 1% from where we open at Globex, that could be a half of a percent higher and a half of a percent lower. And in between these two, that's our 1% move. What happens if we get extreme though, and we just actually move in one single direction the entire average daily range? Well, that's what those levels are. So that's why I started using that indicator. You could use the ATR and just set it to 21. The problem is, I don't understand the math behind it. Or I kind of understand the math, but I can't recreate the math. That's a better, more accurate answer. I can't replicate it. So I wanted something that I could replicate using simple math. So if you look, though, it's not to say that I don't use ATR at all. I do have a 5 bar ATR running, but that's looking at a 15-minute chart at the last 5 bars, right? That's completely different than these average daily range bars. And look at what we did today. We ran the entire average daily range and we turned around. Why? Well, because that's what we have been doing on average. And we had no reason to expect that today would be any different. So on Thinkorswim, you need this indicator. What are you using? ADR on Thinkorswim or ADR on TradingView? For TradingView, let's just scroll back because I just deleted that file out of my computer, but I posted it last Friday and last Wednesday. It'll be a text document for TradingView. What I did is I took somebody else's indicator on TradingView and I edited the lines and levels. And since it already exists on TradingView, they say I can't publish it again because it already exists and I didn't make significant changes to the new one. So I can't just share a link, unfortunately. I actually have to share the text document, which is a little troublesome, but it's not a big deal. And I can go make another text document, but I just deleted it and I'd rather just not make another one. It's not a big deal though. If I don't find it soon, I'm going to give up and I'm going to go. I think I'm in the right area because I remember we did all of these videos right at the end. So, what you're going to want to do is take the code and then make a new indicator from it and don't publish it, or they'll just send you a real snarky letter. Well, I don't know who runs their indicator department, but the guy or gal needs to like drink a little coffee or something because they are snarky. And that's coming something from me where everybody says I'm always sound so grumpy and angry and frustrated when I'm not. This I could sound like this if I win the lottery. I'm going to sound like this. Just too many years in the oil field yelling over loud equipment. It makes me sound. Yeah. Yeah, I think it's just too many years of bourbon and yelling over loud equipment. Back in the day when none of us wore earplugs and they just was like, "Suck it up, kid. Get out there and get to work." And you didn't care about PPE and hearing and none of that stuff. And of course, we all drank bourbon at work because that was just what you do on the rigs to stay warm or to cool off if it was hot or just because you were thirsty. And then they wonder why we're missing fingers. Yes and no. Bourbon's bourbon because it's made in Bourbon County, Kentucky. Otherwise, you can make the same formula in Kansas and they would call it whiskey because you didn't make it in Bourbon County, Kentucky. Yeah, it's only bourbon if you make it in that location. Otherwise, it's called whiskey. But then there's different kinds of whiskey. You got corn whiskey, rye. Well, I got stuck on that one. Rye whiskey. You can have all kinds of whiskeys. Rice whiskey, which is weird, but yeah. 100% agree. Yeah, when I first started, I was like, I can't believe you guys are drinking right now. They're like, yeah, you got to go get us another one, kid. You're the new guy. And I, wow, you guys are drinking at work, which is weird enough. But with all this dangerous stuff, then you just kind of get used to it. Let's see what else we had on the list. Oh, it's because this is up. There we go. Gaps. Gaps are fun. I was really amazed when I first started trading that there were so many kinds of gaps because I thought a gap's a gap. Like, well, ain't it all the same thing? No, it's absolutely not the same thing. And in futures, the gap that we have an opportunity to trade has multiple opportunities. So let's back up to something that I can mess with. This will work. This will work really good. So right here, we're going to talk about a different kind of gap. First, we're going to adjust the settings and we're going to turn off the overnight price action. Come on, Thinkorswim. All right. So we can very clearly see a gap right here. That's TradingView TV. Now that kind of gap, we want to talk about intraday gaps here because we're looking at the futures. Equity gaps and other gaps do exist on higher time frames, and they're excellent for swing trades. But let's just start with the intraday and we'll work our way out. This kind of gap is looking at yesterday's close and today's open. But futures have another gap too, where we close at 4 for retail, 5 for retail with big accounts or other anybody else with a big account, and where we open at 6. That 4 to 6 or 5 to 6, that time frame alone, that 1 hour can have a gap as big as the one that I just circled. So there's actually two opportunities in the overnight for gaps. That 4 to 6 one, let's just call it 5 to 6, and then the other one where we closed at 5 and we opened at 9:30. So that's the gap when we talk about the overnight gap. Equities have this gap too, but it's a little weird because, equities have the AM session and then the regular session and then the PM session. So they got three different sessions that equities get to play in. But even with those three different sessions, you still have the 4 o'clock close and the 9:30 open. And that's what you want to focus on when it comes to equities is that same where did we close? And then now where are we going to open? And it would look the same way. We can see here where we got the gap. We closed here and we opened here. And these gaps very often fill the next day. There's different gaps though. And that's what the surprise was when I first started digging into these myself. Now I've got my own special one we're going to cover, which is called a liquidity gap. We're going to save that one for last. But when it comes to just quote gaps, a lot of us day traders, this is the gap that we're focused on. Yesterday's close, today's 9:30 open, the difference between them. The common gap usually closes in that first hour of trading, and it happens relatively quick. It's because we didn't gap very far and we just work our way back down there and get that closed. It's good that we already talked about profiles because these gaps often close if we're in some sort of consolidation area. That makes sense, right? If we're in a tight, bunched up area, if we're range bound from a daily or a weekly perspective, and then we gap up, we're not really expecting to go anywhere. It's not like these daily or weekly charts where we've got big gaps. Instead, we're just talking about having a daily or a weekly range and then having price stuck inside of that weekly range. And then it gaps up and it's not a big gap. And then we fade right back down and we close it again. But who defines how big is big? I caught a fish this big. It was huge. I swear, but I let it go. I didn't even take any pictures. So big has to be quantified. How big is big enough? Unfortunately, the market you trade has to define how big is big enough. A 1% gap in Tesla is nothing. Honestly, you can wipe that out in like 10 minutes and just keep on going. A 1% move in SPY would be a really big deal. So, to figure out is the gap this time, quote, big, you want to look at previous gaps and kind of get a feel for it. There are gap indicators on Thinkorswim, on TradingView, and what they'll do is they'll highlight the gap. They just like color it, put a cloud inside of it, and really help you visualize, hey, there's a gap there, so that you can spot it easier. Unfortunately, those indicators can be goofy. They can screw up, get it wrong. But if you shop around for cloud indicators, you'll might find something like this, and it's just like it says, it's a cloud or it's a gap indicator. You can find that in the Thinkorswim workbook. I'll be happy to share it with you if you don't want to go over there and get it. I've got multiple ones. They all pretty much just do the same darn thing. They're designed to try to help you visualize the gap. This isn't even a very good one because it stops after 1 day. But you can get other ones that are better and carry the gap forward until it gets hit again. Kind of like those volume profiles and carrying forward the point of control. So this gap, it is the most common, and that's why they call it the common gap. You gap up and you don't go very far away, and then you come back down and you close it, and that's what we expect. But because it's not a big move and because it happens frequently, um, that common gap also really doesn't make you much money because you don't have very far to go and you don't have much expectation of what's going to happen next because that usually happens in a range bound market and that doesn't offer us anything because we're still in the range and we still need to get out of it. You could look for significant news and normal or low volumes on those gaps. The news is generally why the gap happened, and the volume gives you some clue as to how many people are participating in it. But it's a low volume gap, it's not likely to succeed, and the gap gets closed. A breakaway gap, a runaway gap, and an exhaustion gap, those are a lot funner. And those were the ones that really surprised me when I was new. The gap and go play. When I had first came across gaps, I always thought they closed because that's what everybody tells you they do. Oh yeah, gaps close. Gaps always close. If you haven't heard that yet, you will. You'll hear it all the time. Gaps close. That's just what they do. Except when they don't. Like the gap and go, where we gap and we just giddy up. Those are best spotted on the daily and the weekly, and they're some of the best swing trade signals you could ever find. Even as an intraday trader, if you're day trading, this is still some of the best gap trades that you could ever get. If you're recognizing, for an example, that we are gapped up on the low of a range and we're starting to run. Now, this one actually ran back down and closed its gap first, and it's an earnings play, so it's not that awesome, but it sets the tone here. It gapped up, ran back down to get the gap closed, and then it continued to run. But that would be a gap and go if it hadn't closed that gap there. You want it to be at the bottom of a range or at the top of a range. Here's a really good one. And it didn't close the gap. So that's perfect. This one gapped down and just ran. Sure, it tried to come back in a little bit, but it didn't make it. That's a gap and go. It's at the top of of a run and it's headed in the other direction. It's exactly what you want to see. Or even this one's not as good, but it'll do. We closed here, we opened here, and with almost no wick, it just ran. That's a gap and go. It's at the bottom of the zone, it's going in the other direction, and it continued the move. Okay, so gap and goes or breakaway gaps. I don't like my breakaway or gap and goes to be at the top of a zone. So, say we had already run up here, and then the next day we open like way up here. I do not want that. That is not the kind of gap and go I want. I don't want to go higher from here. You'll see those, and if you want to risk them, you can trade those. I don't care for those. Those generally come on stronger volume. They typically start a new trend. That's what the books say, anyways. How you define trend is really the key to that little comment. These 7 or 8 candles can be considered trend. There's nothing wrong with that. It's really beautiful, but take that sentence on a grain of salt. You want to trade in the direction of the gap because you're not expecting that gap to close. You're expecting it to continue to move in the same direction. You do not have to jump fast. This is one of those that you could take a little bit of time because, for an example, this area that I've got on this Apple setup, the mark was back down into this 225, 220 area. If we were gapping and going from 255 or 250, there's no rush. I don't have to get into this at 9:37 in the morning when the options prices are still all jacked up and out of whack. You can give it a little time. Maybe even go down into the intraday and try to find a little bit of a pullback in there so you're not shorting from the lows. I bet if we went back to December 30th of last year, on the intraday, there was some pullback at some point to let us get an opportunity to trade that day, to get in for a short without shorting from the hole. Where's the target? The gap isn't going to give us the target. We're going to have to get that target from other things like going to a higher time frame and looking what's down below or what's above and where could we go along the way. But I really like the gap and go play. The most frustration with this is when we get a gap up from the highs or we get a gap down from the lows and people want to trade it. And that's usually where they get destroyed, especially new traders. When it's been green for 5 days in a row and it gapped every day, and then day 6, they're like, well, I'm going to do it because it's been doing it for 5 days nonstop. And that's the day that it's back to a previous high. And it flips and crushes them on the way back down. And they didn't bother to go to the weekly or the monthly to see that was a previous high and it didn't work and it got ripped in half. How to play it. These are powerful signals of a new trend, often driven by significant news. Again, I don't like the trend part, just ignore that. They are powerful signals, often driven by significant news, earnings, news, um, Trump tweets, whatever. In the current environment, a lot of times it can just be anything to do with data centers, AI, that sort of stuff. You do want to try to find gaps that break levels. So in this one that I was showing here, I don't like the textbook on that. I like mine better. When we're talking about previous levels, the levels in question are the previous day. Now, this one gapped completely outside of the previous day, which is awesome. The one down here, when it gapped, it didn't get very far. Getting outside of that previous day's range would be better. And if you had to wait for it to work its way up there before you finally agreed, then that's what it would take, right? Or some sort of pullback. Like this one, we closed here and opened here, and it did that little loop de loop. It came up and let you in so that you could get short off the highs instead of shorting from the lows. Runaway gaps. These are often called continuation gaps. Now, these are where you, let's see if we can find one that didn't close. We got a couple here, but they closed along the way. It's where you got one, you gap up, and then you gap up again, and then you gap up again. Those are continuation gaps, and those are good mid range. We don't want to see them at the lows. We don't want to see them at the highs. If we're gapping up and gapping up into a significant resistance level like we did over here, don't try to play that next gap up because we got to get through that level, right? We got to be up here. And the concern is that it's going to be a fake break fast failure setup. And that is bear traps, bull traps, that sort of thing. That would be the exhaustion gap. Fake break, fast fail, exhaustion happens at the bottom of runs where we'll get one more gap down, or happens at the highs where we get one more gap up, and it happens to be the fake out, and then it comes crashing and burning on back down. Gaps are really awesome, by the way, depending on where you play them. A weekly gap up is such a powerful thing. The problem is don't let earnings break you on this, right? I think Google had a really good one. Dividends, earnings, these can cause gaps, and in my opinion, those gaps should be treated as earnings gaps, as dividend gaps, not as the same kind of analysis. This is Google, and we've got earnings here, and we've got earnings here, and we got this beautiful gap here. Now we had that one first. That was just a little one, and that gave us a breakout and began the TRB setup. And then it just jumped, man. It just jumped all the way up there, and then it ran. And look where it went, 145 to 195. That's fantastic. That's awesome. And that's a gap that happened in the middle of something. So weekly gaps, and especially big weekly gaps at the bottom of a range and it's turning and going up, or at the top of a range and it's turning to go down, those are wonderful. Tie them into something like a morning star reversal or an evening star reversal. Get a breakout or a breakdown of the previous day's price action, and then look for your other confirming signals, like where are we going, a TRB. Bring in your drawing line so you can mark the mid, because those are going to be areas of concern. And then expansion levels, 50%, 100%, anything that you can add to it. But a gap up on the weekly, that's a very powerful signal, or a gap down. Never fight those, because you're taking more risk than a trade is worth to try to fight a gap and go, especially a weekly. Now, the last one, we're kind of running out of time, but we got time for this one. It's a liquidity gap. And this is a purely intraday thing for me. You can use them on daily and weekly. And I've done analysis that way, but I don't trade it that way. What we're looking for is not price leaving a gap behind like we were looking at in these pictures so far. There is no physical gap at all. Instead, it's a liquidity gap. What we're going to be looking for is an expansion bar, or a leg out. So if you've seen drop base rally, rally base drop, we want leg bars. Let's turn this chart back into the chart it's supposed to look like. There we go. Generally, you find these on events, so CPI, PPI, non-farm payrolls, but you can get them even on the intraday, like we did today. Just randomly out of the blue, boom, some news hit, and we ended up with a really big bar. That big bar is, this one's not a really good example, but this is an expansion bar, it's a leg bar, and that caused a liquidity gap. Now we closed that gap in the very next bar. We went down all the way down to here, we ran all the way back up, and then in the next bar, we got the gap closed. That's not a good example. in the morning briefing, we've talked about these because that's where we get CPI and PPI and non-farm payrolls. And if you can spot when you're going to get one of these, it makes them really awesome and they become tradable opportunities. I'm looking for something here. The best way to get comfortable trading a strategy or a pattern or a setup is to find examples of it and then study those examples in detail as much as you can. This is a leg bar. It's a really good example of what I'm talking about. Yeah, that'll work. This was done on a CPI day. So the bar opens and it just makes this massive move that doesn't look anything like any of the other bars that you've had. That's how we know it's an outsized move or a leg bar. It's much bigger than the previous bars, any other bars. And they're almost always based on some sort of news hitting. I'm sure you could get them where it doesn't happen on news, but I can't remember seeing one anytime recently. Once you get this, that is the gap, and we expect that gap to fill. Of course, you can mark the midpoint, you can mark the starting point, and it could be a gap and go where we gap and we just keep on going. It can be any of the ones that we already discussed. It could be a fake breakout, and we come back in. I don't have it marked, but look at what happened when we got to the mid. We stalled on the mid and we never did get this gap closed. Here is a liquidity gap. We paused at the mid and we got the gap closed before 11 o'clock. Or another example to the downside, we paused at the mid, we got the gap closed before 11 o'clock. Here's another one, a little bit of a digestion up there. Didn't really stop at the mid at all, got back down before 11 o'clock. You get the idea, right? We got back down there again and again and again. So those are the kind of liquidity gaps that I like to play. But even if we can't play them, all of these had unique pieces that made them tradable. No wick on the pop side, closed in the upper portion, or if it was red, closed in the lower portion. So there's some details that make it quote more tradable. But what if it's a big, wicky, ugly, nasty kind of bar that looks like that? Well, there's no gap to play here, right? We opened there, we closed there. What gap? But look at that big old event bar. You get that bar, measure it, mark its mid, mark 50% and 100% higher and lower, so that if we go anywhere higher or lower from that bar, that's where we stalled out that day, by the way. 50% or 100% of this bar, that's where we stalled. Same thing here, really big bar. We stopped at the mid along the way, but we also went measured move above it. So we can use these liquidity gaps to mark out key levels in our trading day. That doesn't mean we have to trade those levels. At the bare minimum, those levels can be warnings for us to just give us a heads up of, hey, don't be careful, don't go long there. We're about to hit this, or you maybe want to take profit because we're about to hit this. Even today, when we had this really big bar, this event bar, I measured it out. Now, you don't necessarily want to use 111s and 1236s on event bars. The bar is made on elevated volume and on market fear, market greed, extremes, and extremes don't usually do well with 111 and 1236. So if we had smashed through the 1236 here, I would have immediately put on the 50 and the 100 as an expectation of a more valuable level lower. We didn't, but that was my play, was to add those other levels because they are generally what you end up needing if you get a big event bar. Otherwise, the midpoint becomes really valuable, and you can anticipate that, and then getting back to where the gap started, which was right here. So we'll just shoot that forward and look at how price reacted when it got there. Instant rejection and brought back down. Rejected again, didn't really fall that much, and then we got above it finally. But it took a little bit, and it didn't matter that it happened and then we were doing this. You would think it should. That was the open. Let's see what the close looked like when we got back there. Yeah, we punched right through that close. But the open of that bar was really important. That's where we got all these responses. So use those candles when you get them. If you know they're coming, CPI, PPI, non-farm payrolls, awesome. You know that's like Back to the Future and knowing where lightning's going to strike. But if you don't know and they just show up in the middle of the day like they did today, that's a gift. Take it and mark your levels out from there. Maybe it'll give you tradable opportunities, maybe not. That could have happened at 3:30 for an example, and I don't want to trade at 3:30, so maybe I wouldn't have gotten anything out of that. But if it has something to offer, shoot, measure it out and see what it's going to give you. So that's what I got, guys. Unless anybody's got questions, we'll just wrap it up. On Friday, we're going to hit the request uh, checklist on quantifying a breakout. And if you guys have topic recommendations, as always, hit me up. I'm always grateful to have a topic to cover. And if you guys don't have any questions, I'd say let's get out of here and get some dinner. Yep, yep. Later, everybody.